Hi, everyone. So, good evening and welcome to the second session in our discussion for financial management. In the previous session, we looked at the issue in respect of the public sector issue, which was public sector or public-private partnership arrangement. Then we turn our attention to look at some few issues that we need to understand when it comes to dealing with working capital management. In our discussion today, we're going to be focusing on three thematic areas that will be in the exam hall, whether I like it or not, and that is business finance. So we're going to look at the concept of sources of finance and then cost of capital calculation. Then we'll get ourselves excited into treasury management, dealing with issues about money market hedge, forward contract issues. Then we will wrap it up on investment appraisal technique. So just using questions, going through a number of questions to see exactly what we can do to put ourselves in the position to pass the examination. So in case you missed the previous session, please you can head on to get access and then watch that video as well as you prepare well for your examination and most importantly help you to pass the exam. So let's go straight up. Let me bring up my screen quickly and then we'll get excited into the discussion for the day. Let's see, what do I have? Yep, here we go. Okay, so starting the discussion with business finance. And business finance, if you remember, is divided into two. So this is where we are talking about sources of finance and then cost of capital. So sources of finance and then cost of capital. So sources of finance looks at where are we going to get our money from? Where are we getting money from? That is sources of finance. Then cost of capital means what is the cost of that money? Because at the end of the day, as a business, it is important we understand where we are getting our money from. So in the previous session, we spoke about the various sources of finance. Now we want to look at the calculation aspect where we are focusing on dealing with cost of capital. And so if we are getting the money from shareholders, then that is equity finance. Then when it comes to equity finance, it is then important for us to understand how to calculate the cost of equity using either the dividend valuation approach or the capital asset pricing model. You're going to be seeing all of these coming up in a moment. And even under the dividend valuation or dividend approach, we're going to have the constant dividend and then the constant growth in dividend formula in calculating the cost of equity of the entity. Then we come to debt finance, because if you go to long-term debt finance also, we have to calculate the cost of debt. Now, when it comes to the calculation of the cost of debt, it depends on the type of debt we are dealing with. If the debt is irredeemable debt, then that is easy. So cost of irredeemable debt, we're just going to go with I over PO, that is the interest over the value. If we are taking tax into consideration, then 1 minus T, that is irredeemable debt. But if it is a redeemable debt, then our focus is going to be on the internal rate of return, and we're going to be getting into that also in a moment. So cost of capital, equity, we calculated. Debt finance, we calculate it. But sometimes an entity may be financed with partly equity and partly debt. And so in that case, what will happen is that we will merge equity into debt, and that will give us weighted average cost of capital. And that is the idea that we must understand when it comes to dealing with cost of capital there in that case. So we're going to be taking some questions, walking through the principles and making sure that we understand the various things that we need to be mindful of when it comes to calculating cost of equity, when it comes to calculating cost of debt, and most importantly, bringing the two together, going into the weighted average cost of capital. That is also going to be an important area for us. So back into our question kit that we've been referring to in the series, and we are going into question number 2, that is CAT-CO, and going to open up the discussion on that. So CAT-CO. And so let's see the requirement of this question. A says we should calculate the cost of equity of CADCO using the dividend growth model. We are calculating the cost of equity using the dividend growth model. Now, if you remember the issue about cost of equity using the dividend growth model, that is going to be the dividend that we are paying 1 plus G, PO plus G in the discussion. So we calculate our cost of equity. Now remember that in the exam, or it depends on what is happening, but you're going to be having a number of formulas coming up that you need to be mindful of, right? But you're going to be limited on the formula workflow that the examiner will give you. So this is ACCA F9 or financial management. So the formula sheets, we're going to be having a number of things coming in there. This is value of the company when we are dealing with the issue in respect of the dividend valuation model. But then if we are dealing with cost of capital, the journey is different. So yeah, there are some of the formulas that may be in the formula sheet. Others will not be in the formula sheet. But also always, you must make sure you understand the principle generally in respect of the formulas, so that even if you're not given something, you know how to work. And we'll come back to this. Then B says we should discuss whether the dividend growth model or capital asset pricing model should be used to calculate the cost of equity. C says we should calculate the weighted average after-tax cost of capital of CADCO using the cost of equity of 12%. D says we should calculate the project cost of equity for CADCO for the planned joint venture. And then E says discuss whether changing the capital structure of a company can lead to a reduction in its cost of capital and hence to an increase in the value of the company. So quite a lot of things there, but let's go read a story. CADCO has in issue 8 million shares with an ex-dividend market value of $7.6 per share. Okay, so that is our PO, 7.6. A dividend of 62 cents, so that is DO, has just been paid. The pattern of dividend is as follows. So we remember when it comes to the dividend growth approach, we can use the Gordon approximation method or the historic method. From the presentation here, we are giving the dividend growth over the period. So we have 2010 up until 2013. Now, the growth there is 4. So first, what we would do is to get our J. So the J is going to be the nth root of the final minus the initial final divided by the initial minus 1. Remember, the root sign doesn't cover the 1, where n is going to be the number of years given in the question minus 1. Okay, the number of years given in the question minus 1. So if we check, the current year is 2013. The previous year is 55.1. So it will be 62 cents, 0.62, divided by 0.55. Is it 55? Initial, the first one, 0.551. Got to be careful. Now, the root sign is going to be what root? Minus 1. We have 4 years, so 4 minus 1 will be 3. So we're going to have the root sign coming up. Okay, so the n here is 4 minus 3. 4 minus 1. That is the number of years minus 1. So this is in percentages, so we punch that out. So root fraction 0.62, 0.551 minus 1, and that times 100, and that gives us 4% approximately. So the growth rate is 4% per annum. All right? So once we have the growth rate to be 4% per annum, then we can calculate the KE, which is going to be the dividend that has just been paid 0.62 into bracket 1 plus 0.04 divided by the market value given to us, $7.6, 7.16, plus the growth rate giving us an amount of 0.04. So we punch that out, 0.62 out, 1.04 out over 7.16 plus 0.04, and that is going to times 100. That's going to give us 13%. So our cost of equity is 13%. Because remember, the formula has to be times 100, right? This whole formula is in percentages. Okay, because the cost of equity has to be 100. So that is the A aspect of the question. Calculate the cost of equity using the dividend growth method. That's A. Very sweet, simple, straight to the point in respect of what we are supposed to do here. So that's our first part. Then we come to the second part of the discussion in respect of that. And this is a discussion area. So what does it say? It says, discuss whether the dividend growth model or the capital asset pricing model should be used to calculate the cost of equity. Now, each of these models have their advantages and disadvantages technically. Because when we use the dividend growth model, then it means that we are calculating the cost of equity based on the dividend potential of the entity. Now, the disadvantage with that method is that it is difficult to estimate the actual growth in the dividend that will happen in the future. Because if you look at the growth rates from this question we just solved, we got 4%. Now, this growth rate was calculated using historical information. And so that doesn't mean that going into the future, dividend will grow at the rate of 4%. So sometimes that is a challenge using the dividend growth method, but it's a good method used to value the business. The capital asset pricing model, on the other hand, here we are taking into consideration the risks associated with investing in the business. But also here, it is sometimes difficult to calculate the equity beta for the entity, right? Then number two, the risk-free rate of return. How do you reliably use that? So to decide whether we should use the dividend growth model or the asset pricing model, it depends on the objective of the entity. If the objective of the entity is making the investment, interested in some inflows of dividend on a regular basis, then we go with the dividend growth model. But the disadvantage there is the difficulty in estimating the dividend growth rate. But if the entity wants to invest for long-term sustainability and growth, then it may be interested in the capital asset pricing model, where we are taking into consideration the risks associated with the investment, and hence we are using the capital asset pricing model. But in that case also, sometimes it is difficult to reliably estimate the equity beta and then also determine the return on the entire market as well as the return on government bonds reliably to do the estimate. So that is the discussion that we can have there in that B aspect of the question. Then we go to the C aspect of the question. It says that we should calculate the weighted average after-tax cost of capital. Now, this will be given to us in our formula presentation like this. So this is the formula for the weighted average cost of capital. Now, I'm going to build tax into the story probably. So I won't build tax into the final formula because there are two ways of presenting. Either you build the tax in arriving at the cost of equity, you build in the tax in arriving at the cost of debt, or you build in the tax in the calculation of the actual WACC. So it's discretionary on how you want to present. So C here. So our WACC is going to be this formula. So it means that in the calculation of the weighted average cost of capital, we need a number of things. We need a value of equity, that's VE. We need a value of debt, that's VD. Then we need the VE plus VD. Okay? Now we have been given KE because they said we should assume KE is what? 12% here. So we are giving KE to be 12%, but we need KD. We don't know. So let's go read a question and see if we can figure out these things. We can get VE easily because market value per share is $7.6 or 7.16, and there are 8 million shares in issue. So if we go like that, then it is going to be 8,000, assuming we tell the examiner we like to work 3 zeros up. So give me a sec like this. Let me see if I can do some better presentation here. So VE should be 8,000 times 7.16. So what do we have? 8,000, 7.16. That is 57,280. So that is VE, value of equity. Then we need VD. Let's go read. It says, Calco also has in issue 8.5% bond redeemable in 5 years' time. So this is a redeemable debt. If it is a redeemable debt, then the cost of debt shall be the internal rate of return. We'll come back to that in a moment. In 5 years' time, with a total nominal value of 5 million. The market value of each $100 bond is 103.42. So stay with me. We need a market value of the debt, VD. And so that is going to be 5 million or 5,000. The nominal value is 100. And then the market value is 103.42. So 103.42 over 100. Okay? Because it says each $100 bond is 103.42. The $5 million is the nominal value. So the $5 million for each $100 bond times the market value will give us the market value for the bond. So 5,000 fraction 103.42 over 100. And that is 5171 for the VD. So we add VD to VE, 57,280, and that is giving us VE plus VD, 62,451. I hope you are getting the idea. Very easy picking up the items. Very easy picking up the items. Now, we have KE, so no problem. But we need KD. As we've seen, it is a redeemable debt. Because it is a redeemable debt, it means the KD is going to be internal rate of return, IRR. So it means we have to use the present value schedule to calculate the internal rate of return, because the internal rate of return then becomes the cost of what? Debt. So let's go. We're going to have the year up here. Then we'll have cash flow. Then we will bring in the issue in respect of the discount factor. We'll get a present value. Now we're going to work this for 2 years or 2 rates because we are doing IRR. So, and it's discretionary on the rates workflow. Okay, it's discretionary. You can start with 10%. And then you do the first workings. After that, then you make the decision if it is positive, then you increase the rate. If it is negative, then you reduce the rate. So it's like a trial and error journey here. So maybe we will do the first one with 10%. All right. So let's bring in our cash flow. Year 0 is going to be the market value of the bond. And we are told each bond is 103.42. Okay. So 103.42. That's the market value. No need to write that there, but I'm just writing. Then from year 1 to year 5, we'll bring the interest after tax, preferably, because we want to work with the amount into the system here. So the interest after tax will be the coupon rate of the bond is 8.5. So the interest is going to be the $100 times 8.5 into bracket 1 minus the tax rate. In the question, we are told that the corporate tax rate is 30%. So 0.3. So pay attention carefully, because I am working for interest after tax. And the reason I love that workflow is because that way I wouldn't have to build the tax into the WACC formula. But it depends. If you want to build a tax into the WACC formula KD after tax, it's your discretion. But I like to build it in here. So what do we get annually? 100 times 0.085 into bracket 1 minus 0.3, bracket close, and that is 5.95. Okay, 5.95. Then in the 5th year, we bring in the redemption. What were we told? We were told that this bond will be redeemed at the nominal value. So we will still get 100. Sounds good? So the market value is certainly going to be the negative. Year 0 now is 1.00, as you know already. So 103.42. So this is what's happening. We are doing 10%. So the interest, we are receiving 5.95 for 5 years. So we can do annuity on that. Then on the redemption, we will do the normal discount factor table on that. So we go to our table and read. You'll be presented with this in the exam also. I go to the annuity table, okay, annuity table. Then we are doing 10%. So 10%, the 5th year, all right, will be brought in that regard because I'm using 10%. So that'll be 3.791. All right, then let's read present value table. 10% the 5th period. For the redemption, 0.621. Now we multiply up to get a present value. So 5.95 times 3.791. And that is 22 point maybe 56. Then 100 by 0.621. That would be 62.1. So we check it out here. Negative 103.42 plus 22.56 plus 62.1. And that gives us negative 18.76. Now, what does that mean? If we do the first one, it is negative. It means the rate was too high. So the second one, you reduce the rate. If you did the first one and it was positive, it means the rate is too low. So in the second one, you increase the rate. So let's reduce the rate to what? Again, everything we are doing here is discretionary. So the goal is not to get one negative, one positive. The goal is to apply the rules. And so the law is the law, the rule is the rule. And so if we want to have a reduced rate in the second flow, so we have discount factor at, then we have present value. So in the second flow, I don't know, maybe let's do like 3%-ish. Okay. So 1.00, we still have 103.42 here. So if we are doing 3%, annuity, 3% for 5 years. Annuity, 3%, the fifth period, 4.580. 4.580. Present value, 3 years, 3%, the fifth period, 0.863. So we multiply up. Remember what you are multiplying. You are still multiplying the cash flow by the discount factor. So 5.95 times 4.580. And that is 27.25. Then 100 by 0.863. And that is 86.3. So that the NPV on the 3% will be 103.42 plus 27.25 plus 86.3, and that is a positive of 10.13. So now we have our NPV, and then of the 10% NPV of the 3%. So in the internal rate of return workflow, the NPV of A is the one with the lowest NPV, okay, in that regard. Then the NPV at the lower rate, which is 10.313. Then the NPV B is the NPV at the higher rate, which is 18.76. So that the A is the lower rate, 3%. The B is the higher rate, 10%. Sounds good? So these are the things we will now go and substitute into the IRR formula. So KD, cost of redeemable debt, which is the same as internal rate of return, will now look like A plus NPV-A over NPV-A minus NPV-B, B minus A. So we substitute those figures into it. So the A is the smaller rate, 3%, plus NPV-A, 10.13 over 10.13, minus 18.76, then 10 minus 3, or 10% minus 3%. All right? That is our flow. Now, you got to be careful on how you are punching, because you're going to work for this one, then you add the results to the 3%. Sounds good? You add the results to the 3% in respect of that. So we see there, what do we have? If you have a good calculator, you can punch it. 10.13 over 10.13 plus 18.76. Bring in a bracket, 0.1 minus 0.03, bracket close. Then we add that to 0.03 times 100%, and that is 5.45. Okay, 5.45, or give and take 5.5%. So this is the cost of debt calculation for redeemable debts. Okay, debt is a redeemable debt. So for all redeemable debt, the cost of equity calculation is going to be IRR. And that is the idea about that. Now, we've not answered the B part of the question yet, too. Right? Because the B part of the question says, calculate the weighted average cost of capital. But the premise we are building is that before we calculate the weighted average cost of capital, we need VE. So we calculate it because it's not given. We need VD, value of debt. We calculate it because it's not given. Then we add the two up, it gives us the VE plus VD. KE was given as 12%, no problemo. But we need to calculate KD, cost of debt. And the debt in this question is irredeemable debt. And cost of irredeemable debt is the internal rate of return. And then you do the workflow, and now we got 5.5%. So now that we have all our indicators, let's now substitute it into the WACC formula and then go ahead with our workflow. So weighted average cost of capital is going to be VE, which is 57,280 divided by VE plus VD, which is 62,451. 62,451 multiplied by KE, which we were given in the question to be 12%. That'll be in the first bracket, plus the debt issue. VD is 5171. VE over VD, VE plus VD is 62,451 times KD that we just calculated, 5.5. We punch that one as well. That is the idea about the weighted average cost of capital. So we punch these respectively. I'm going to punch them together. If you have a good calculator. So big bracket, 57,280 over 62,451 multiplied by 0.12, bracket close, plus bracket open fraction, 5147 over 62,451 multiplied by 0.055, bracket close, and that is giving us around 11.46%. So if I want 11.5%, this is the weighted average cost of capital calculation, the B part of the question. Very sweet, simple, straight to the point. All right? Very sweet, simple, straight to the point. That's the idea in respect of that. And for that workflow, what was the marks there? 5 marks. Is it worth it? We don't know. We are doing what we have to do, applying the principles in the manner that we have to apply the principle. So that is the C of the question. Let's come to D. D then says, calculate the project cost of equity for CADCO for the planned joint venture. Stay with me carefully. Calculate a project-specific cost of equity for CADCO for the planned joint venture. Okay, so let's go and finish reading the question. Again, one of the things you got to be mindful of is, as I say always, if you follow my work, knowing which part of the story is to help you to solve which segment of the requirement of the question. Very important. So you don't become overwhelmed with unnecessary information based on where you are at. Okay, so let's look at the final paragraph. CADCO is planning to invest a significant amount of money into a joint venture in a new business area. Okay, so I want you to understand what is going on here. If our company is going to invest in a new business area, then this is outside our normal business. So we need to know the risk in that business area, which is going to be the asset beta. Then we will re-gear that to calculate the equity beta for our company. Then we will now use that equity beta to calculate the cost of equity. It means we're going to be using the capital asset pricing model. Now, it's important you understand what you are doing on this level so that when you read the question, it helps you to draw principles up directly. So we take it again. CADCO is planning to invest a significant amount of money in a joint venture in a new business area. So since it's a new business area, it means that to calculate the cost of equity for our company, CADCO, we cannot use our current equity beta. We must know the asset beta for that new business area, use that to recalculate the equity beta for our company, then we can use that equity beta to now calculate the cost of equity using the capital pricing model or capital asset pricing model. It has identified a proxy company with a similar business risk to the joint venture. The proxy has an equity beta of 1.038 and is financed by 70% equity, 25% debt on a market basis. Okay. Now, I could begin to get goosebumps on a number of things, but let's finish reading the last sentence. The current risk-free return is 4%. Okay, so RF is 4%, and the average equity risk premium is 5%. Note, equity risk premium is the difference between the returns on the market, which is RM, minus the risk-free rate. So return on the market minus risk-free rate is what is referred to as equity risk premium. CADCO pays a profit of this, and they have an equity beta of 1.6. So this is what I was telling you about. If you ignore the fact that they are in a new business area, or they are going to do a joint venture in a new business area, and you use this equity beta of 1.6 here to calculate the cost of equity of CADCO, you are wrong. Why? Because the question said, sister, calculate a project specific. So let's go. D for Dorothy. So first things first, we are given the equity beta of the proxy firm. That's good, but we need to calculate the asset beta of that new business area. So let's calculate asset beta. So using the proxy firm's data, using the proxy, I'm just adding some of these things as we are in class, and I got to explain some of these things to you. Using the proxy firm's data, calculate the asset beta. Now, if you remember, asset beta equals the equity beta. This will not be given to you in the exam hall, so you must know it. Equity beta divided by 1 plus into bracket 1 minus the tax rate, bracket close, times debt over equity. Quite an interesting formula. So the fraction is actually extending, okay? So let me do something well like this. So this is the asset beta formula. So we would just have to substitute the various things that we have available to then go away. So if we check, equity beta is 1.038. So 1.038. Am I right? Yeah. Divided by 1 plus into bracket 1 minus. Now, we are told CADCO pay a tax of 30%. We are not told the tax that new business sector pays, but we're going to assume that the tax rate is the same for every industry. So on the average, for the purpose of our calculation. So it will be 0.3. Then we multiply that by, they said their capital structure is 70% equity, 25% debt. The simplest thing you can do is that you can ignore the percentage and deal with the absolute, so that it becomes 75 or 25 over 75. Okay, so because you are not giving the amounts and you are giving the ratio of 75% equity, 25% debt, just assume that it is an absolute figure and work with it, because it will be the same. If you assume that the capital structure of the whole company is $100 million, 75% of 100 million is 75. 25% of 100 million is 25. So in a situation like this, just ignore the percentages and just work with the absolute, because you will still come around with the same idea. So we punch this out to give us the ungeared asset beta, so that we can now re-gear to calculate the equity beta for our company. So 1.038, 1 plus into bracket 1 minus 0.3, bracket close, times fraction 25 over 75, and that is giving me 0.842. Okay, 0.842. So that is the ungeared asset beta for the industry, for the new business that we are going into, new business area, so that we can now re-gear that to calculate equity beta for the project. Okay. So if you want to calculate equity beta, what do you think you do? If this is the formula for asset beta and you need equity beta, what do? Cross multiplication. So your equity beta is simply going to be your asset beta multiplied by the whole of those guys. Give me a sec, because I want to just copy them and bring them in here. Multiply by the whole of this. That's quite an interesting environment. So to make it simple on myself, maybe let me put this in a bigger bracket like this. Do you get the idea? Just trying to make sure. So you just do a cross multiplication of the asset beta formula, then you get your thing for the equity beta. So we have the asset beta, which is what we just calculated, 0.842, multiplied by bracket open, 1 plus into bracket 1 minus 0.3, bracket close, times debt over equity. If you remember our workflow here, the debts of our company, CADCO, is 5171, equity is 57280. So 5171 over 52680. Hey, am I right? No, 57280, Nhyira. 57280. You get the idea? So now we punch that out to get our equity beta, the re-geared equity beta. So you got to be careful about the punching here as well. Quite an interesting thing. So how do I punch? Okay, let me do 1 plus into bracket 1 minus 0.3, bracket close, multiply by fraction 5171 over 57280. I get all the answers. Then I multiply it by 0.842. Boom. I'm getting 8 point or 0.8, maybe 95. So that is our equity beta. So follow the thought process. The entity is investing in a new business. So what is the project specific cost of equity? So you use a similar business data in that new area, get your asset beta. Sometimes it will be given to you in the question, so you don't have to calculate it. But you must know that you have to now use that asset beta to calculate the regeared equity beta for our company. Because you cannot use the equity beta for our company that is given to us here. Because the examiner gave us equity beta of 1.6. But you cannot use that. Because this 1.6 equity beta is in the current business of operation. But we are going into a new business of operation. So that is why we need to have the regeared equity beta. So now we have everything, so we can calculate the cost of equity. As we said, in this environment, you're going to be using the capital asset pricing model, which is the risk-free rate plus your equity beta into brackets, return on the market minus the risk-free rate. And as we said, return on the market minus risk-free rate is the same as what? The equity risk premium. All right? Equity risk premium. In that case. So let's substitute. Risk-free rate, we are told, is 4% here. Plus equity beta, what we just calculated, 0.895. Multiplying equity risk premium, 5%. So we punch that out. So 0.895 times 0.05, the results will add up to 0.04 times 100%, so that I get 8.75, 8.48%. So I can say 8.5%. So this is the D aspect of the question. Calculate a project specific cost of equity of CADCO for the plan joint venture arrangement. That's the idea there. Again, you see that it's very easy, right? It's very easy if you understand the principles very well, right? Because if you don't understand the principle, then you're going to be in a hot soup. But if you understand the principles very well, you're going to be comfortable at the end of the day. All right. So that is our idea here on these set of questions, looking at the various things that we need to understand in respect of this question. Then, so let me bring it up so that, so slide 1 here, the A aspect of the question, calculating the cost of equity using the dividend growth model. Slide 2, the C aspect of the question, calculating the weighted average cost of capital. And the fact that there is a redeemable debt here, so we use IRR to calculate KD, then we can now calculate the weighted average cost of capital here in that regard. Then the D part of the question, the entity going to invest in something else, and so we now find a way to calculate what is going on for the entity. So that is the idea about calculating cost of equity, dividend valuation model, capital asset pricing model, calculating weighted average cost of capital. There is a cost of debt in the mix, and we are using it's a redeemable debt. If it was irredeemable debt, then cost of debt is just 1 over the market value. If there is tax, then we'll do 1 minus tax, and then that is all in that particular case. Let's look at another question, and we'll go down to maybe question number 4 here. In the question flow, question number 4. Still a business finance related issue. Okay, still a business finance related issue. What do we have here? For 10 marks, the examiner says, evaluate whether Sportsco should use leasing or borrowing as a source of finance. Leasing or borrowing as a source of finance. Now, if you remember the principles on this, it means the entity is contemplating whether they should lease or they should buy. Which one is cheaper? We will need to discount the present value of the lease payment. Then we get the present value of also the borrowing option. The borrowing option will be the cost of buying the asset, any maintenance cost we have to pay, all those will be outflow. Then at the end of the period, if there will be any scrap value, that will be an inflow. So we discount all of the cash flows on the borrowing option as well. Then the one that is lower becomes the basis for making our decision. So let's look at it. Evaluate whether Sportsco should use leasing or borrowing as a source of finance, explaining the evaluation method which you used. So let's go. Sportsco is considering to finance acquisition of a machine costing $750,000 with an operating life of 5 years. There are 2 financing options. Option 1, the machine can be leased at an annual lease of $55,000 per year, payable at the start of each year. Please stay with me carefully here. Stay with me carefully here. So that is option 1, the leasing option. So Sportsco, option 1, which is leasing. And we said we would discount the cash flow on the lease. Now, if you check, it's over 5 years. But the annual lease payment will be made at the start of each year. What does that mean? It means that we'll have 0, 1, 2, 3, 4. Because if the payment has to be made at the start of the year, then it has to be available at the end of the previous year. So the project life is 5 years. So this is PL, project life. So this is LP, the lease payment. So the lease payment is payable at the start of each year. So year 1's lease payment should be made available in year 0. Year 2 will be in year 1. Year 3 will be in year 2. Year 4 will be in year 3. Year 5 will be in year 4. What does that mean? It's because so you can get your discount factor well. So if I pull up the slide, gonna have the period here. Gonna have the cash flow coming up. Gonna have the discount factor coming in. Then I'm going to have the present value coming up. So year 0 will make the first lease payment of $155,000. What is the discount factor? Give me a sec. Let's finish reading. Probably we can get a discount factor coming in for the machine. The machine could be bought at this price using a bank loan at an interest rate of 7%. At the end of the 5 years, at the end of the 5 years, the machine could be scrapped 10% of the value. If machine is bought, the maintenance cost will be this. Okay. So we are not giving any direct discount factor, right, or discount rate, but we can use the interest rate on the loan as the basis. Because you know, in leases also, the interest rate implicit in the lease would have been used. But we don't have any interest rate implicit in the lease. So we will use the 7% bank loan as the discount factor at 7%. Now, year 0 is 1.10 or 1.00. So that figure will still be 155,000. No problem. Then from year 1 to year 4, we will pay 155,000. Okay. And there we can do annuity. So that is the concept that I was highlighting, that don't be deceived that you are hearing 5 years. So you will go and use annuity for 5 years. You will be wrong. You will be wrong, because the payment is made at the start of each year. So now, year 0 will make the first payment. Then the remaining 4 payments will be made at the end of the year before the start of the next year. So 7% annuity factor, 4 years. 7% annuity factor, 4 years. It is 3.387. So 3.387. You good? So we multiply up 155,000 times 3.387, and that will be 524,985. So we add it up to get the present value of the cost of leasing. Sorry. So present value of the cost of leasing. So plus 155,000, and that's going to be 679,985. So when we lease the asset, this is the flow. The only challenge here is paying attention to the timing of the lease payment. Paying attention to the timing of the lease payment. Let's go to the second option, the buy. Or borrowing to buy, right? What's the statement? Borrowing to buy the asset. So that also will discount the cash flows. So we have the period coming up. Gonna have the cash flows coming in. We'll have the discount factor still at 7%. Then we'll have present value coming up. So what's the story? It says the machine could be bought for 750,000. That will be now, right? So year 0, 750,000. That's an outflow for us, 1.00, 750,000. Then it says if we should buy it, the interest rate is at 7%. Then it says at the end of the 5 years, the machine will be scrapped at 10% of its value. That's an inflow. We'll come back to that. If the machine is bought, maintenance cost will be 20,000 per year. Okay. So from year 1 to year 5, we'll pay 20,000 every year. So that's the maintenance. So this is the purchase cost, if you want to. All right. And then this is the maintenance cost. In the 5th year, year 5, we'll bring the scrap value, which will be an inflow for us. So they said it will be 10% of the value. So 10% of 750 is going to be 75,000. Sounds good? 10% of 750 is going to be 75,000. So again, we will work with annuity, but this time around you will read 5 years because it's 1 to 5. So annuity 7%, 5 years, that is 4.100. Then you go and read present value because the scrap value will read it on present value. 7%, the 5th period. 7%, the 5th period, 0.713. So we multiply up respectively 20,000 times 4.100. That's 82,000 here. Then the proceeds 75,000 times 0.713. That's 53,475. So when we borrow to buy the asset, so present value, cost of borrowing will be how much? Minus 82,000 minus 750,000. And I'm getting 778,000. Sorry. 778,525. So, what do you think? If we should borrow the money and buy the asset, it will cost us 778,525. If we should lease the asset, it will cost us 679,985. So which one is cheaper? The leasing option. So that should become the decision rule. So we say that the cheaper source of financing is the leasing, since it is lower than borrowing. Are you getting it? This is the answer to the A part of that question. Yeah, you are seeing 10 marks here, but in the exam, or you may see this like 5-ish marks in that regard. But that's the idea there. We are done. So again, it's under financing decision, right? So that's A aspect of the question. Should we lease or borrow to buy the asset? That's the idea there. Okay. Then we go to the B aspect. It says, discuss the attractions of leasing as a source of finance of both short-term and long-term. Yes, really, in the financial management class, in the short term, we can say that, let's use operating lease to then go in there and then get our lease faster. Then in the long term, we can use what? Finance lease, generally. So on the overall, in the FM class, yes, we can say that. But you got to understand that when it comes to the financial reporting class, really, you know that the lessee is not the one who is going to be classifying the lease as an operating lease or a finance lease. Nonetheless, on the overall, leasing serves as a source of finance to the entity, whether as a short-term tool or a long-term tool to help the entity to get it financing. So operating lease, short-term situations, finance lease, long-term situation. But as I said, you got to be mindful of the fact that in the grand scheme of the way leases are supposed to be seen now based on the modification of the accounting standards, we can lease and we don't have to classify whether it's a finance lease or operating lease. Nonetheless, the entity is at that position or is in that place to be able to make that decision in that regard. So that is that theory discussion there, how leasing can serve as a source of finance in the short term and also in the long term. Then we come to the C part of the question, and that is the concept of Islamic finance. I want you to stay with me carefully here, because if you remember, we said when it comes to sources of finance to private sector entities, we could talk about short-term sources of finance, long-term sources of finance. They have all of their things. Then we also have Islamic finance. So let's look at a question here. And I'm going to be bringing up a slide to look at what we have here in that particular case. In Islamic finance, explain briefly the concept of riba, interest, and how returns are made by Islamic financial instruments. Now, if you remember the concept of Islamic finance, in the realm of Islamic financing, riba or interest is forbidden. Why? Because it's like you are getting money for not doing anything. You get a concept here. So in Islamic finance, the word interest is forbidden. Because how do you give me money and say, Nhyira, pay me 20% every time? So every time you are getting 20%, but you didn't work for the 20%. You didn't do anything for me, but you are getting that money. So that is why the term interest or riba is forbidden in Islamic finance. And so how is returns, as per the question, and how returns are made by Islamic instrument? So if I can give you money, support your business, but I am not supposed to get interest for not doing anything, then how do we make returns in Islamic finance? The way returns is made, that means the lender here makes returns, will be based on the type of financial instrument we are talking about. So let me bring up my slide and let's go through a number of the types of the financial instruments. Then we can discuss the concept of riba a bit further. I don't know if this slide is going to be much visible or not, but I think it should be. And so if you look at the types of Islamic finance, we can talk about issues in respect of, first, muduraba contracts. Now, in muduraba contract, here, profits are shared between the partners in the proportion they agreed in the contract, while losses are borne by the provider of finance. So, remember we said we forbid interest. So how does the provider of finance make returns? It depends on the type of financial instrument we are dealing with. So if the financial instrument we are dealing with is the mudaraba contract, then it's like a partnership deal. But then what is going to be happening here is that if there is a profit, we share it based on the contract, but any loss will be borne by the provider of finance. That is muduraba contract. Then we come to musharaka contract. In musharaka, profits are shared between the partners in the proportion agreed in the contract, while losses are shared between the partners according to their capital that they contributed. That is musharaka. So in musharaka, how did we say we should share profits? In the contract, we will share profits like that. If there is a loss, how much capital did everybody contribute? Okay, maybe I brought money of 10,000. Kukwa brought his skills and expertise that can be valued at whatever, 20,000. Then that becomes the basis for sharing the losses. That is musharaka. Then we come to sukuk or sakuk, depending on the school you attended and who taught you how to pronounce things. But shakuk or sukuk. This one, certificates are issued which are linked to an underlying tangible asset and which also transfer the risks and rewards of ownership. The underlying asset is managed on behalf of the sukuk holder. So here, it's like asset financing. So I want to borrow money to buy a delivery van. Okay. So what is going to be happening is that you can't say you will give me the money to go and buy the delivery van, then every month I should give you 10%. Because again, riba, interest, is forbidden in Islamic finance. Okay, so then you who I'm coming to for the money can buy the asset, finance the asset, and I will be using the asset, manage the asset. Any benefit, you get some benefit at the end of the day. So what's going to happen is that if you spent whatever, say $10,000 to buy the vehicle for me, at the end of the period, you may end up paying me about $12,500. And then the $12,500 becomes the returns that I made on the asset that I financed for you to use. So that is also sukuk or shakuk, depending on the school you attended. So muduraba, musharaka, sukuk. Then the next one is murabaha contract. In murabaha, payment by the buyer is made on a deferred or installment basis. Then returns are made by the supplier as a markup is paid by the buyer in exchange for the right to pay after the delivery date. So this is more or less like, buy now and pay later. Because, in every buy now and pay later deal, you will have to pay more than somebody who is paying with cash right now. And as we've said, you cannot charge interest. So I wouldn't say, hey, if you buy now, you pay $5,000. But if you're going to be paying me 2 months from now, I will charge you an interest of 10% on the $5,000 so that 2 months from now, you will pay me $5,500. We are forbidding interest. So what is happening in murabaha is that we're just going to be adding a markup. So what is our profit markup? So we'll add a markup. Technically, it's the same as interest, but we don't call it interest. We call it the profit we are making on the transaction. That is murabaha. Then the last thing is ijara or ijaira or ijara, depending on the school you attended and who taught you how to pronounce these things. In ijara, which is equivalent to a lease agreement, returns are made through the payment of a fixed or variable lease rental payment. So ijara is like, okay, I need an asset. I don't have money to buy it from you, but can you lease it to me? So you give me the asset, I use it every year, and then I pay you back something. That is ijara. So what are we saying here? We are saying that when it comes to the Islamic finance environment, the word interest is forbidden. Why? Because interest is like you did nothing to earn that right. So it's forbidden. So how then does the provider of the assistance, provider of the asset, provider of the finance get their returns? It will depend on the type of Islamic instrument, that Islamic financial instrument that we decide to go for. Mudaraba, Ijara, Shakuk, Murabaha, and then Musharaka. These are the things you must understand when we talk about Islamic finance. So again, look at the way the question was structured and look at the way we have answered the question. Because the examiner says, hey, In Islamic finance, explain the concept of riba or interest. So that's the first part of the question. Then he says, how returns are made by Islamic financial instruments. So the examiner is going 360 for Islamic finance. Tell me about interest. Tell me about how returns are made under each of the Islamic finance instruments. These are the things you must understand when we talk about Islamic finance. It's a dedicated question that the examiner can ask us in the exam hall. Either he will go something like this for us to explain the Islamic finance instrument, explaining the concept of riba, or the examiner will say, hey, listen, I want you to just define the following. Maybe muduraba or shakuk, and then ijara, then you're supposed to talk about them. So you must know about these in respect of the way they are structured. That's all about Islamic finance. Then the last aspect of this question says, discuss briefly the reasons why interest rates may vary between loans of different maturities. Discuss briefly the reasons why interest rates may vary or may differ between loans of different maturities. Because you know this, and if you're a finance student, you've heard this over and over again, that when it comes to dealing with the issues about interest rates, they're going to vary. So that if you're borrowing the money for a short period of time, then the interest rate is going to be pretty low. If you're borrowing the money for a long period of time, then you're going to lock up my money for a long time, so the interest rate is likely to be high at the end of the day. The question that the examiner is asking you here is, why is that the case? Now, there are a couple of theories that we can use to apply or answer this question about the reasons for this. The first one is the concept of liquidity preference, the liquidity theory. The second one is the expectation theory. And then the third one is the market segment theory. What do these mean? What do these mean? The liquidity theory simply suggests that investors prefer to have cash flow and so require compensation for lending. What does that mean? It means the longer the period for which the money is lent, the higher will be the interest rate to compensate the lender for deferring their use of the loaned cash. So that is the liquidity preference. I need the money to move me. But now that you are taking that money for 5 years, it's going to be with you for 5 years. Okay, you got to be willing to give me a higher interest rate. That is the liquidity preference theory. But then if it is a short period, then I know the money will come quickly. I could use it to earn money somewhere else. So the interest rate on short-term financing or short-term lending will be lower. The second reason is the expectation theory. And this theory suggests that the relationship between the short-term and the long-term rates can be explained by expectation regarding interest rate movements. Where future interest rates are expected to rise compared to short-term interest rates, the yield curve will slope upwards. And so what is the expectation? So if currently we expect that, so let's say you borrow, I lend you money. Or there are two parties, party A and party B. And I'm lending money to party A 5 years. And I'm lending money to party B at 2 years. My expectation of movement in exchange interest rate will influence how much I'm going to be charging at the end of the day. Then the last thing is going to be the market segment theory. The reason why interest rates may differ between loans and different maturity could be because of the balance between the supply and demand of what? The money available. So, for instance, if we are in a sector or an industry where it is hard to finance projects, then when you get the financing eventually, the interest rate is going to be higher. But then if it is an industry or a sector where it's easy to get financing, then the interest rate is going to be what? lower on the average in that particular case. These are the things you must understand in respect of this question 2 area. And that brings me to the end of business financing. So sources of finance. Where do we get the money from? In the short term, trade payables, short-term loans, bank overdraft, leases in the short term. In the long term, where do we get the money from? We can do debts. Even debt, there are different types of debts. We have the redeemable debt, irredeemable debt, preference shares are there, zero-rated coupon bonds are there. What is the cost of their calculation? We must know that. Then we come to equity finance. This is where we are using shareholders' retained earnings, or we are doing right issue or doing new issue at the end of the day. So what is the cost of capital? Using the constant dividend method, constant growth in dividend, or using the capital asset pricing model to calculate the cost of equity. Then we said sometimes the entity can be financed, a little equity, a little debt. In that case, we need to calculate the cost of capital, which is the weighted average cost of capital. And that is going to be the issue in respect of bringing the two together. Then the final thing is Islamic finance. Now, Islamic finance, I must say, it's really a developing field because there are some schools in outside of Ghana, in Europe, where you have MBA with specialization in Islamic finance. Yeah. A full MBA program with specialization in in Islamic finance, because it is an alternative to that. Now, this doesn't mean it is only, practiced by Islamic institutions or Islamic financial houses. No, even normal banks are also what? Coming into using it in that regard. I don't know. I think I even heard of a bank here in Ghana is trying to implement the Islamic financial instrument structure so that, the word interest is out, but then they will still get a returns on giving you money or buying the asset for you at the end of the day. So it's a huge field that is still developing or under developing. So these are the things you must understand about business finance. We don't know where the examiner will come for you or will come from, but we know definitely the examiner will get goosebumps about some things that we need to understand. All right. So let's go to our next area of discussion briefly, and that is going to be treasury management. Treasury management. Let's see if I can see my question that I want us to go through. What's the name? Rose Co. It says, evaluate whether a money market hedge or a forward market hedge would be preferred on financial grounds by Rose Co. So let's read a story. Then we can build the understanding there. It says, Rose Co. expects 700,000 euros from a creditor in Europe in 6 months' time. Okay. So, from a credit customer, in Europe, in the European Union, in 6 months' time. So, the company is due to receive some money. And so, they are fighting to handle the exchange rate issue, so they are not going to be exposed. So this is currency risk management, okay? Foreign currency risk management. And so money market hedge or forward contract, which one should we go for? Now, the idea about forward contract is where we have an arrangement with the bank and say, hey, listen, we're going to get, or we will need X amount of money at a certain future date. Let's agree how much are you going to exchange for me in that regard. That is the idea about the forward contract in the currency terms. And then money market hedge, it depends. Now, this one, the company is due to receive money. So we will borrow equivalent of our currency of the money, and then we deposit it. So that by the end, when the 750 euros come, we will use it to pay for the loan we took directly. And we'll do the workings right now, then you will see it. The spot rate currently is 2.349 euros per dollar. 2.349 euros per dollar. And the 6 months forward contract is this. Okay. So it means we can do the forward market hedge right now. So Roscoe forward. We don't have to do any calculation. Market hedge. So if in 6 months' time is this, then how much are we going to get? So if $1 is 2.45, then how much will it be? Because you have to know whether you're going to divide or multiply, right? So 2.412 equals $1. So 750,000 will be what? So we're going to divide. So in the forward market environment, the amount we will get will be 750,000 over, what is the rate? 2.412. And that is what we will get in dollars in 6 months' time if we go with a forward contract. So 750,000 divided by 2.412, and that is $310,000, 945. So under a forward contract arrangement, this is what we're going to get. But let's come to the second arrangement, which is money market hedge. So money market hedge. So let's see. The following commercial interest rates are available to Roscoe. Okay. So euro is going to be this. Now, so you got to understand what's happening here. We are going to be receiving a foreign currency. So what is going to be happening is that we would have to borrow that foreign currency. Okay. So we will borrow the euros, convert it into the dollar, and deposit the dollar. Then at the end of the period, we will get our dollar. Interest that will accrue on the euro that we will borrow in 6 months' time will be equal. Then we can use the 750,000 that is coming to pay the bank, and then we are off. Because we already have the dollar in an investment account also that we will liquidate in 6 months' time to finance our activity. Do you get the idea? So if we are going to receive money, then you borrow in the foreign currency, deposit in the local currency, and then when the money comes, you use it to pay the person in that regard. That's the idea in respect of that. So let's see what we have here. Roscoe does not make any surplus cash to use in hedging the future euro receipt, because sometimes there could be some net off issues. If there are net off issues, then not all the money will be subject to the hedging environment. And that is something you would have to be mindful of, because it will be based on the context of the structuring of the question and how you actually present your answers at the end of the day. But let's go. So let's go first, and then euros to be borrowed for 6 months. So euro borrowing for 6 months. Now, the interest rate they've given is per annum. So 6 months rate will be what? 8% over 2, which is going to be 4%. So the rate is 6% in that regard. So euro to borrow will be the 750,000 divided by 1 plus R. So 1 plus 0.04. So what do we have? 750,000 divided by 1.04. And so we will borrow 721 maybe 4 euros. So at this point we have the 721,154 euros. So we convert it at the spot rate into the dollar. So the dollar value of the euro at a spot rate, which is what? Our spot rate right now is 2.349. So 721,154 divided by 2.349. So in dollars, how much do we have at our disposal right now? Because I want to be putting, let me put the currency signs up as we build a story. So my answer, 721,154 divided by 2.349. So now we were going to be having 307,005 US dollars. Are you getting it? 307,005 US dollars. Now, we then deposit that, and interest is going to accrue on that money. So, let's get a future value of the dollar. Of the dollar deposit. So what is the interest rate when we deposit a dollar? It is 2% per year. But remember, we are working for 6 months. So the 6 months interest rate, deposit rate will be 1%. So we are depositing 307 and 5 times 1%. Because that will be the 6 months rate. So 307 and 5 times 0.01. Sorry, I missed something. Because the future value, so this will give us the interest, but plus the money itself. So let me go this way, because this will give us only the interest we will earn, but plus the money, so that we'll get a future value. So let me present this way rather, so that we can maybe build it like this. So 307 and 5 times 1.01, okay? So that we can get the amount inclusive of the interest. So 3.07 and 5 times 1.01. And that'll be $310 and 75. So get an image here. So what are we doing in the money market? As I said, the ideology is this. So right now we borrow 721,154 euros from the bank. The idea is that in 6 months' time, the interest will accrue up to the money we are due to receive from the credit customer, 750,000. So that when you get that money straight, you give it to the bank. Then we liquidate our investment and we will get 3, 10, and 75. So between the money market hedge, the money we will get in 6 months' time in dollars, and then the forward contract, the money we will get in 6 months' time, which will be the right one to go for at the end of the day. If you check between the two, which one is giving us more money? Because you want more money. The forward contract is 310,945. The money market hedge is 310 and 75. So what do you see? You see that the forward contract will be what? Better. Because it will give us more money than the money market hedge arrangement. So that is an English we have to write, because the examiner says, evaluate whether money market hedge and forward contract will be preferred on financial grounds by Roscoe. So now we've done the calculation. So on financial grounds, the forward contract should be preferable because we'll get more money. So the forward contract, what was the word they used? The forward market hedge. The forward market hedge is better as it gives an extra amount of, how much extra are we getting? 310,945 minus 310 and 75. How much better off are we? Give me a sec. Let me put this here because I'll put this in brackets so that the figure will come. 310,945 minus 310 and 75. Oh. That's $870. So we go for that. This is the answer to the A part of that question. Money market hedge and then forward market hedge. Purely on financial grounds, it is better to go for the forward contract in that regard. So that's why I'm saying that if we are the ones who are going to be making payment, then what is going to be happening is that we will need to borrow our currency, convert it into the foreign currency, put it into the investment account so that when the time is due, you liquidate that foreign investment account to pay your supplier because you borrowed in your currency. And that's how you deal with money market hedge when we are making payments. Did you get the process there? So if, assuming this question was, oh, Roscoe is to make payment to a credit supplier, right? Roscoe is to make payment to a credit supplier. Then in that case, we will borrow the equivalent of that in our currency, the dollar. Then we will convert that into, using the spot rate, into the foreign currency. Then you will deposit that foreign currency. When it is time to make the payment, the interest that will accrue on the foreign account plus the money itself should be equivalent to the money we owe the supplier. So you liquidate that foreign investment account to pay your supplier because you borrowed in Ghana City. This is the idea about money market hedge. It's very easy. Like that. There is no magic anywhere. It's very easy like that. So you have to know how you play around. Here we are receiving money. And Nuntina, we borrowed in the foreign currency. Then we translate it into our currency. so that we can deposit our currency. Because when we receive that foreign currency, we will use it to pay the foreign loan we went for. But if we are supposed to make payment, then we will borrow our currency, translate it into the foreign currency, deposit the foreign currency. When it is time to make the payment, liquidate the foreign currency, foreign investment to pay our supplier. That is the idea about money market hedge. Okay. Then we look at the B part of this question here. B. What does the B part of the question say? It says that briefly explain the nature of forward rate arrangement and discuss how a company can use a forward rate arrangement to manage interest rate risks. Okay, to manage interest rate risk. Now, forward rate arrangement, if you understand this well, the idea is that we would need some money at some time in the future. So we want to go to the bank and then have an arrangement with the bank to give us a certain rate that will help us in the future. So that is the forward contract. So the entity is on one side, right? The finance house, or in this case, let me just say the bank, is on the other side. So forward rate arrangement, it's coming in and telling the bank that, hey, I need some money at some times in the future. What interest rate will you give to me? So it depends on what is happening generically, but then we could agree that, okay, the bank will give us the money we need. How much do we need? Let's say $100 million. We want to go buy something, so $100 million. So the bank will say, okay, I'm going to give you this, and we need this money maybe in maybe 2 years' time. That's too far though, but maybe let's just do in a year time. Okay, so a year from now. So the bank will say, I'm going to give you at an interest rate of whatever, let's say 12%. So that is forward rate arrangement. The idea about how this works is this. When the time is due for the bank to give us the money, if the actual interest rate at that time is higher than that we have agreed, the difference would have to be given to the bank. Very important. So permit me to bring my slide up on this because I want to go through it with you like this here. So some one-liner definitions for the highlights, then we go. So the forward rate arrangement can fix the borrowing rate on a sum of money for an agreed period starting on an agreed future date. So the company can use this to manage its interest rate because the FRA fixes the future borrowing rate for an agreed period and hence fixes the company's future borrowing cost. But this is the twist. If the future interest rate paid by the company turns out to be higher than the borrowing rate in the FRA, the bank will compensate the company with the difference between the two rates applied to the agreed sum for the agreed period. If the future rate, or if the company compensate, the opposite occurs, the company compensates what? The bank. And so at the end of the day, the net effect is that the company is locked into the borrowing rate specified in the FRA. That is the idea in respect of that. Now, so what happens technically is that the FRA doesn't allow the company to benefit from favorable interest rate movement because you're going to pay me what we agreed that you will pay me. And the reason why the company will enter into such arrangement is because the company is afraid that interest rates will rise above what they are supposed to be. That is the idea about the forward rate arrangement and how businesses use it to deal with issues in respect of interest rate risks. And those are some issues that I want to bring to your attention under the treasury management environment. Now, there are other theory issues that you have to understand here. The issue in respect of the various methods of hedging. We've seen the forward arrangement. We've seen the forward market hedge. We've seen the money market hedge. We also have invoicing in home country. Now, invoicing in home country is a strategy that will work for, a company, say in the US or in Europe. If you're in Ghana here and you are selling to someone outside of Ghana, unless you are selling to someone in Nigeria. So let's say, because the Ghana cedi is higher than the Nigeria naira, right? So if you are selling to someone in Nigeria, then, and you want to reduce any foreign exchange effect, then you can invoice to the person in Nigeria in the Ghana cedi. So any foreign exchange risk, they will handle it because you will get your Ghana cedi coming up. That's invoicing in home currency. Then we have the concept of leading and lagging. Leading means that we make payment in advance prior to the receipt of the goods because we are expecting a depreciation of our currency and the appreciation of the supplier's currency. So that is the concept of leading. We make the payment in advance prior to the receipt of the goods. But where the entity speculates that, the currency is going to appreciate, so our currency will appreciate and the supplier's currency will depreciate, then they will adopt the concept of lagging, which means we will receive the goods and make payment to the supplier at some time in the future because by then our currency might have appreciated and their currency might have depreciated, so we are in a stronger position to benefit. That is the concept of leading and lagging. So leading, we expect future depreciation, so let's pay before we receive the goods. Lagging, we expect future appreciation of our currency, so we delay to make the payment at some time in the future. Then we also have the concept of net off. Net off is where the entity equally, so let's say we are a Ghanaian company, right? So we import. So if we import, that means we pay in dollars. But then we equally also sell some things to other people outside of Ghana and we invoice them in dollars. And so what is going to be happening is that at the end of the period, there are some receipts in dollars. Then we have to make some payment in dollars. So the receipt in dollars will be used against how much we are due to pay the supplier. Then only the difference, we will find another way to hedge against it, either using the forward contract arrangement or using money market hedge to get that difference. So those are some other theory issues that we need to understand in this environment of, treasury management in that case. You see that financial management is not difficult, You see that thing? It's not difficult, Like, if you get the concepts right, the principles right, I can guarantee you it's really, really not difficult. So let's go to our final part of our discussion, and that is looking at a question on investment appraisal technique. Because there will be a question on investment appraisal in the exam hall. So we want to look at one question like that will bring us into the arena of investment appraisal. But we're going to take a short breather, right? Just a short breather, and then we'll come back and then come and continue. So stay tuned and it will take a short breather. You see the countdown on the screen, and it will come back to come and continue. All right, so welcome back from the break as we continue with our discussion. So, investment appraisal, another crucial area that we need to understand when it comes to dealing with financial management. Now, when it comes to investment appraisal, there are various things that we need to be mindful of. Certainly, the first thing will be the capital asset pricing process, or sorry, the capital budgeting process. In other words, the process that we go through in making those capital asset decisions or capital budget decisions. So the first one will be idea generation. And so the idea generation could come from research and development, could come from the management or the board, could come from internally employees making suggestion. It could be even customers making recommendation. So that's the first step, idea generation. Then we come to the second step, which is idea screening, which is to evaluate which of the ideas we can really or projects we can pursue. And the screening phase, some indicators that we're going to be relying on may include issues such as how much that project is going to cost, what is our long-term goal as a company, is it what is in line with our mission, plan, strategic direction of the company. All of that will feed into that second layer of idea screening. Once we finish screening the idea, we come to the third stage, which is the project appraisal. And so this is where we're going to be using various methods of project appraisal to appraise the project. And so we have the payback period. This is where we're going to be using it to deal or evaluate between more than one mutually exclusive project, and the entity is seeking to undertake only one of them. And so we can use the payback period to look at which of the projects pays us faster or quicker. So the one that pays us within the shortest possible time becomes the project that we select. And there are some disadvantages when it comes to dealing with the payback period, because number one, it doesn't take into consideration the time value of money. That is quite an interesting thing. So it doesn't take into consideration the time value of money. Number two, it does not look at the cash flows after the payback period. That's another disadvantage there. Then it is not built, it doesn't have the effect of taxes or the implication of taxes on the investment project, although it could be embedded into it. But that is the payback period. And so to deal with one of the limitations of payback period, which is it doesn't consider the time value of money, we go to the second method, and that is the discounted payback period. The discounted payback period is just like the normal payback period, but this time around, we'll take into consideration time value of money. What does that mean? It means that we're going to be discounting the project into their present value, right? And then we take that into consideration in determining. So you realize that when we take time value of money into consideration, the expected payback period is going to increase slightly than it was in the normal payback period. But that is the idea there. Then the third method is going to be the accounting rate of return. So this is where we are going back to the accounting class, calculating the accounting rate of return, which is like ROSI, generally in that regard. So the average annual profits divided by the average investment times 100. And the decision rule there is that if the accounting rate of return is greater than the entity's cost of capital, then certainly the entity undertakes the project. However, if the accounting rate of return is lower than the entity's cost of capital, then the entity rejects the project. So that is the concept of the accounting rate of return. Then from there, we come to taking into consideration time value of money, which is where the normal NPV comes in. So comprehensively, we consider various issues like working capital management, working capital, tax, capital allowance on the project, and all of those things in the NPV environment, which is what we're going to get into. And then we look at internal rate of return as well, which is, you saw the idea of internal rate of return when we're calculating the cost of irredeemable debt. It's the same idea, discounting the cash flows, but this time around, you're going to calculate internal rate of return. Now, in NPV, the decision rule is simple. If the project has a positive NPV, it means that we have the green light to undertake it, right? But if the project has a negative NPV, then we cannot undertake it. Why? Because if the project has a positive NPV, it means that undertaking the project will increase shareholders' worth by that positive NPV. And if the project has a negative NPV, it means that it will reduce shareholders' worth by that figure. That's why we don't consider negative NPV project. In IRR, we expect the internal rate of return to be greater, because another name for the IRR is the break-even rate, which is the rate at which the NPV of the project will be zero. So basically, these are the things that we must understand. That is the third stage. And so depending on whichever method we are applying, we will make a decision. Then a project is going to be selected, it is implemented, and then the project is monitored and managed. And that is the idea about that. So those are the things we must understand generically when it comes to dealing with investment appraisal in that regard. And sometimes in the investment appraisal environment, we could have an A question like what we solved earlier, where we were asked to find the project specific cost of equity, which then in that case, it will become the discount factor that we will use in appraising the project. So you got to be careful about the styling of the question, because we could have cost of capital coming in under investment appraisal. For us to calculate the cost of capital, maybe weighted average cost of capital, then we can use that to now discount the net cash flows from the project, so we can determine the NPV of the project. So those are the things that we must understand in respect of dealing with NPV. Then you come to sensitivity analysis, which is what analyzing the risks or building into the system risks and uncertainties, so that in case the variables we are using they change, what will be their impact on the NPV of the project, right? So the variables we used to appraise the project, if they change, what will be the impact on the project? And we're going to be getting into that as well as we proceed in our discussion when it comes to investment appraisal. So let's use that thought as a guinea pig to go through this question that we have here as we bring our discussion to I can't hear. Oh, okay. So I missed those things. I mean, my sound was not coming. Can you imagine that? That's a lot of time wasted. Okay, so what the heck was I taking? So I was talking about Racing Co. in that regard. And we are saying that here we are calculating the net present value. And I said, when it comes to the calculation of the net present value, what is happening here is that we have a lot of workings to do, like the capital allowance and all of those workings to do in Racing Co. In investment appraisal. Then I was mentioning that the schedule preparation will depend on how taxes are paid. Taxes can be paid in arrears, which means 1 year in arrears. So if the project life is 4, the NPV schedule will be 5, because the tax for year 1 will be paid in year 2. The tax for year 2 will be paid in year 3, in that order. But if they say taxes are paid as and when income is generated, then if the project life is 4, we will also have just 4 years coming in that regard. That is the idea about what I was mentioning. So let's proceed and see what we have here. The initial investment payable at the start of the first year. The initial investment payable at the start of the first year. If the investment is payable at the start of the first year, that means that is year 0. Now, you got to be careful. That was what we mentioned earlier as well. So if we have to make the payment at the start of the first year, then the money should be available in year 0. So it's going to be now. 5 million, and then has a scrap value of 500,000 at the end of the 4 years. Now, that's also something I want you to understand, because when it comes to the investment and the investment has a scrap value, sometimes the scrap value could be receivable maybe a year or 2 years after the end of the project life. So if, for instance, they say, oh, scrap value of 500,000 is expected to rise in the second year after the end of the project, then in our NPV schedule, we will have to add 2 more years where the scrap value will come in that period. So that is another thing you have to be mindful of when it comes to the NPV schedule preparation. There is some uncertainty about the price, about what price can be charged for the units produced by the investment project, as this is expected to depend on future state of the economy. The following forecasts of selling prices and their probabilities have been given. Okay, good news. So when you are giving forecast and probability, you use that to calculate the average selling price per unit. Or whatever it is the examiner gave us, you will use the probability and to calculate the average selling price. So workings, let's begin to take some easy marks. So workings 1, we are dealing with the sales. So first, let's get the average price. The way we get the average price is to multiply the probability by the selling price at each probability schedule. Then when we finish, we add all up, and that gives us the average price. So 35% on 25 could be 8.75. 50% on 30 could be 15. 15% of 35 is 5.25. So our average selling price per unit is going to be the addition of the 3. Okay, the addition of the 3. So plus 15 plus 8.75. And that is giving me 29 Ghana cedi, $29 per unit. Sounds good. So probability to get expected value. So average selling price is going to be $29. Let's continue. These selling prices are expected to be subject to annual inflation of 4% per annum, regardless of which economic state prevail in the future. So whether the economy is going to be at 35 or 50 or 15, inflation rate is going to be what? 4% per annum. What does that mean? What does that mean? It means this figure you are seeing here are going to be year zero, because they said current price terms. So these are in year zero. So our inflation will start right from year one. So let's go build it up and get our figures coming up. So we're going to have year 1, 2, 3, and then 4. So we get, maybe let me build 0 into the system just for the selling price situation. So selling price per unit. So right now in current terms, now, which is year 0, it's going to be the average selling price you calculated, 29. Okay, the 29. Now, inflation is 4%. It means we will do 1 plus R exponent n, right? So it's going to be 1 plus 0.04 exponent 1 for year 1, exponent 2 for year 2, exponent 3 for year 3, exponent 4 for year 4, exponent 5 for year 5, in that order. Now, you have to be careful to know where and when the inflation is starting. So 29 times into bracket 1.04, and that is 30.16. You want to work to 2 decimal places. So 30.16. Now, instead of doing exponent 2 on the original, I could just multiply this by the factor 1.04, and that gives me 31.37. Then I could multiply that by the factor 1.04, and that is 32.62. Multiply that by the factor 1.04, and that is 33.93. The best place is to do 2 decimal places. Forecast sales and production volume and nominal variable cost. So you got to be careful here. The variable costs are in nominal terms. It means they already include the effect of inflation. Because you have to be mindful, the sales are in nominal terms. It means the variable costs are also in nominal terms. So we don't have to calculate any inflation on them again. They are already in nominal term. If they were in real term or in current terms, then they exclude the effect of inflation. So let's see. Sales are given respectively. So let's bring the sales unit here. We're going to work in thousands, okay, to keep things simple. So 150, 250, 400, 300. So that our sales value will be in thousands. Please always work in thousands, so that you can keep the approximation and the plenty coins at the back at rest. All right. So you can, move easily. So what do I have? 30.16 times 150. That is 4524. 31.37 by 250. That is 7843. 32.62 times 400. 13 and 48. 33.93 by 300. That is 10,179. So that is our first workings, getting the sales revenue. Okay, which will feed into our NPV schedule as we proceed. incremental overheads of 400 per year in current price, keyword, in current price, will arise as a result of undertaking the investment project. Incremental overheads. So we will consider that. Because remember, in investment appraisal, any non-relevant cash flow will not be considered. Like fixed overheads absorbed will not be considered. But incremental overheads are considered. Incremental working capital will be considered. So let's see. A large proportion of these overheads relates to energy cost, which are expected to increase sharply in the future because of energy supply shortages. If it was in Ghana, it wouldn't be because of that. It would be because they ran ECG to the grounds like they are doing now. So overhead inflation of 10% per annum is expected. All right. Now, we could work for that or build that into the workflow. Okay, we could work for that or build that into the workflow so we can save some time. So I'll build that into our workflow. The initial investment will attract tax allowable depreciation on a straight line basis over 4 years life. On a straight line basis over 4 years. The rate of corporation tax is 30% and tax liabilities are paid in the year in which they arise. Okay. So since tax are paid in the year or tax liabilities are paid in the year they arise, it means we will still stay with our 4 years. If it was in arrears, then we would have done the 5-year schedule. So we can do working capital workflow as workings too. I don't know if I can do that here, looking at the space I have. So working capital. If we check, because it's on a straight line basis, there is a scrap value of 500,000. The asset costs 4.2 million. So we bring the total allowable depreciation. So total tax allowable depreciation will be the 5 million minus the scrap value. So 5,000 minus the scrap value of 500. So we'll have 4,005. Now it's on a straight line basis. So the annual allowable depreciation will then be this figure divided by 5. Because that's over 5 years. So 4,005 divided by 5. So that gives us Ebaze. Give me a sec. So 4,500 divided by 5 is 900. Hey, is it 5 or 4? No, 4 years, sorry. 4 years. The project life is 4, not 5, Nhyira. So 4,500 divided by 4 is 1,125. Now that is the allowable depreciation every year. But what is the tax benefit that we will get? Because your tax benefit is the allowable depreciation multiplied by the tax rate. So the tax benefit per annum will be 1,125 times the tax rate. In this question, our tax rate, we are told, is 30%. So 30% of my answer is 337, but to the nearest whole number, so we can do 338. This is how we calculate capital allowance if it is granted on straight line basis, or the tax benefit if it is granted on straight line basis. If it is on the reducing balance, the flow will be different. You will do your reducing balance the way you know how to do reducing balance. Okay, got to be mindful of that. And we are told that Racine Co. has traditionally used a nominal after-tax cost of capital of this per annum. Remember that the discount rate given to us must also correspond to the cash flows we are using. So far, all the cash flows we are using are in nominal terms because the selling price was in real term, but we inflated it. The variable cost is in nominal terms, so we will be using it. The incremental overhead is in real terms, but we're going to inflate it. So all the cash flows are in nominal terms. It means we must use nominal cost of capital. But if the examiner had given us a real after-tax cost of capital, then we would have used the Fisher formula. Then we can now come and calculate the nominal cost of capital. You know the Fisher formula, right? That's the purpose for the Fisher formula. Okay? So if we are given the real cost of capital and we need nominal, you interchange and work. H is the general rate of inflation. R is the real rate. I is the nominal rate. So you substitute it and then you make whatever the subject you are looking for. And that's the idea there. The general rate of inflation will always be given. So either you are looking for the real rate or the nominal rate in that case. Then you have to also be mindful of the fact that there is tax in this question. So giving us the after-tax cost of capital is what we needed. Assuming it was the nominal before tax cost of capital, then we would have to calculate the nominal after tax cost of capital. So if I have before tax and I need after tax, I would just do 1 minus tax by the 11, and that would have given me what? The after tax cost of capital. So those are all nuances that can be planted in the question. So you don't just read and go away. You must make sure you are getting the context of the question so that the necessary adjustments that must be made will be made. But in this question, Fisher is not coming to town. In this question, we don't have to adjust the cost of capital because it is already after tax cost of capital. And there is tax in the question, we are going to get after tax cash flows. So no P. If there was no tax in the question, but we were given after tax cost of capital, then we would have to recalculate before tax cost of capital. So it depends on the context of the question and the way you dance. All right. So now that we are done, let's look at the NPV schedule. So the net present value schedule. So we're going to have the year 1, 2, 3, 4 neatly because tax is paid in the same time. We are working 3 zeros up as we mentioned in 1,000. So the first thing is to bring our sales, which is coming from workings 1 here. These figures. So permit me to see if I can copy them and bring them in. All right. Then we bring variable cost. The variable costs were already given in nominal terms in the question. So we pick them up here. Nominal variable cost. So we pick them up 2385 for 200. And then 70, 80, 57, 30. We subtract that to get our contribution because revenue minus variable cost gives us contribution. So what do we have respectively? Let me format my calculator to sorry, to refresh it. 4524 minus 2385, and that is 2139. Then 7843 minus 4200, 3643, 3643, 13,048 minus 7080, 5968, 10179 minus 5780, and that is 4399. All right, 4399. That is the idea there. Then we can bring in the incremental overheads in the question. If you remember, we are told it's 400 per year, but in current terms, and I said we'll do the inflation on the face, so we don't have to work for that separately. So overheads, it's 400. It's inflating at 10%. So 1.1 times 400, that's 440 for year 1. Times 1.1, that's 484 for year 2. Times 1.1, that's 532 for year 3. Times 1.1, that's 586 for year 4. So we take that out so that it gives us the cash flow before tax. All right, so cash flow before tax. So what do we have? 2139 minus 440. That is 1699. Now, since I'm there, I'm going to calculate the tax at once on my figures. Our tax rate is 30% so that I can, move in a way. So times 0.3, that's 510. The tax is an outflow. 3643 minus 484, that's 3159. We get 30% of that for the tax, and that's 948. Year 3, 5968 minus 532, that's 5436. We get 30% on that, and that's 16, maybe 31. Again, remember, tax is paid as income rises, so it's the same year. That was what I was saying, that assuming it is in arrears, then year 1 would have come to year 2, 2 would have gone to 3, 3 would have gone to 4. Then in that order, we would have add another year to the normal project life. Year 4, 4399 minus 586, that's giving us 3863, 3813. Give me a sec, let me check this figure again. 10179 minus 5730. Oh, it's 4449. 4449 minus 586, 3863. How am I having some figures in line and some figures out of line? Okay. Then tax of 30%, that is 11 maybe 59. So that is the idea. Then we bring in the tax benefit which we worked for. So the way the tax are paid, that's the same way the tax benefit will also come in. So again, assuming we are doing in arrears, the same slide will be the way the tax benefit will come. So the tax benefit, we are told, per the workings we did, we are getting 338 every year. And that's an inflow. So 338, 338, 338, 338. Remember, it is a straight line method. If it was a reducing balance method, the tax benefit wouldn't have been the same. So the method of capital allowance is also important there. Then what else do we have? Let's see. There's a scrap value at the end of the project, so we could bring that up so that we can add everything in the mix. So the scrap value is 500 coming at the end of the year. Then we can now get cash flows after tax. So the project cash flow. After tax. So nothing here. So we are adding from contribution 1699 minus 510 plus 338 1528. Then 3159 minus 948 plus 338. And that is 52549. 5436 minus 1631 plus 338. That is 4143. Okay. 4143. Next. 3863 minus 1159 plus 338 plus 500, the scrap value, 3542. So that is the cash flow after tax from the project. Then we bring in the discount factor. So what's our discount factor here? The nominal after tax cost of capital is 11%. So at 11%, and we can read that on the present value table. So 11%, the first table is the present value table. So here is 11%. So these are the things we are going to be reading. 0.909, 0.821. Okay. Then 0.731, 0.659. There we go. So we can now multiply up to get our present value. So we multiply up respectively. I have the last one, so 0.659. It gives me 2334. 4143 times 0.731. It gives me 30, maybe 29. 2549 by 0.821. It gives me 2093. Then the last one, 1528 times 0.901. It gives me 1377. So we add them up to give us the total present value. It's like my space is already exhausted, so I have to go to the next page. So total present value. And that will be equal to, I could present this way. So we add them up, 1377 plus 2093 plus 3029 plus 2334 and that is 8833 for us there. No, give me a sec on something. This is 0.812 rather, not 21. Be careful, because if you miss the discount factors, you're going to have a problem. Because arithmetically, if you are wrong, you are wrong. Okay, 0.812. So that is 2070. So let's go. 1377 plus 2070 plus 3029 plus 2334, 8810. Then we bring the project cost, because it will be paid in year 0 anyways. Initial investment. The initial cost of the investment, I think we are told, is 5 million, I guess. Yep, 5,000. So this is a good project. All right. So the expected net present value is going to be 3810. Now, are we done? No, because the question said calculate the expected net present value of the project. That's what we have done. And then the second aspect of the question says comment on its financial acceptability. So what did we say? We said if the project has a positive NPV, we accept the project. So that is the second part of the question, which we have to write down to say that, oh, the project is financially viable as it will give a positive NPV of 3810. This means that undertaking the project, Racine Co. will increase the shareholders' worth by 3810, and hence they should undertake the project. This is what you must understand in respect of the investment appraisal. Now, in this question, the only thing missing was working capital. Because when it comes to the working capital, it is the movement in the working capital that we bring. There are two concepts about working capital you must understand. Number one is that all working capital outflows over the life of the project will come as an inflow at the end of the project. That's the first concept. Then the second concept is that where working capital will be required regularly over the life of the project, in subsequent years, only the incremental working capital will be considered. So that is something you must understand there. So slide one here for the workings we did for Racine Co. Slide 2, the NPV schedule. And then the final slide, making the decision. I didn't write the English, the comment, but I explained it to you. So you got to write it down, because if you miss it, then you are going to be losing the marks in respect of that particular area in that regard. So basically, these are some of the things that we want to share our thoughts on with you in the session today, looking at business finance, cost of capital, cost of equity, cost of debt, weighted average cost of capital, Islamic financing, money market hedge, forward contract, and then dealing with issues about investment appraisal. And these are all thematic issues that the examiner is going to be asking you about in the exam hall that we need to understand. So that's it about this, and we're going to wrap up here today. I don't know, maybe we're going to probably have another session before your examination for the financial management, but it all depends on how our schedule will be like. if it is possible for us to have another session before your exam, or maybe the evening before your exam, if we have to have another session, then certainly we'll have that session before you go into the exam hall. But these are some of the things that time will allow us to bring to your attention, using questions to crystallize some of the principles. Remember, in the exam hall, you will see working capital management, and the rules are the rules. You will see business finance, calculating cost of capital, cost of equity, cost of debt, or weighted average cost of capital. The principle is the principle. You just have to know and expose yourself to number of questions to understand the structuring at the end of the day. Business valuation is there. I mean, it's the only thing that we've not really touched on, but business valuation is there. You are valuing a business. You want to make sure that you go through that as well, because you're going to be having some questions there. Then the public sector issues, that is Public Expenditure and Financial Accountability Framework, that is PFAR. Then public-private partnership arrangement, because when it comes to sources of finance, we said in the public sector, on the central government perspective, apart from taxes, non-tax revenue, grants and donations, loans, and other sources, one way governments can get money to finance capital projects is through public-private partnership arrangement. And so PPP is here in financial management. You have to know about that. And then certainly public procurement, how goods, works, and services are procured in the public sector. So the various methods of public procurement, you must know about that. The principles of public procurement. That's a 10 marks issue between public procurement and then the PFAR. 10 marks waiting for you in the exam hall that you need to be mindful of. Then the last part of the discussion is going to be technological issues. That's just 5% of your syllabus. Some IT issues that you need to understand, IT in finance, that you have to be mindful of. So basically, these are the things you must understand. And then introductory aspects, those theories in the introductory aspect, you must also be mindful of them. So when it comes to financial management, these are the things you must understand. As I say always, the recommended approach will be, there will be theories in the exam hall. And so when you get to the exam hall, you want to read through all the questions, and then the theories that you can do quickly, you start with them and do the theories. From there, then you can start approaching the calculation areas, and then you make sure that you are working with speed and accuracy and paying attention to the context of the question, because if you miss the context of the question, then you are on your way to zero at the end of the day. These are the things that you must understand, and if you can do that, wish you all the best as you go into the exam hall, and we'll catch you some other time as well as we continue with our discussion. Thanks for watching, and I'll see you in the next one.